Hello, everyone. My name is Dr. Uchenna Cole James, pharmacist and stock options trader. Thank you for joining me today on this platform where I will teach you how to invest with less. And how do we do that? By trading stock options. So thank you for joining me today. Today, we're going to discuss how to ensure that your bid-ask spread is tight. What that does, it allows you to keep more money in your pocket. So I'm going to give you 3 takeaways to ensure that you have a tight bid-ask spread. I'm going to show you an options chain. Okay, so I use a platform called Thinkorswim. I've been trading for over 5 years, and when I first started trading, nobody taught me this. However, I'm going to share it with you today because the fastest path to mastery is through coaching. So this is the example of a chart, the SPY, and this is what an option chain looks like. So I want you to really pay close attention to the volume, the bid and the ask, and open interest, okay? So these 3. Right here, and open interest, okay? Okay, so I was trading this stock called Melly. Okay, and Melly today looked like it's having a really good day, and the volume has increased. Normally, Melly trades less than 200,000 shares. And I got into this trade, and I was up $3,000, and I was feeling myself. $3,000, that's good money for me, especially within 5 minutes of getting in the trade. So I said, I'm about to get out of a trade. $3,000 profit after 5 minutes, I'm golden. I immediately tried to get out the trade, and I could not get out the trade with my $3,000 profit. The reason why that was happening was because the wide bid-ask spread. Let me show you what I'm talking about. So I was trading. So what is the bid-ask spread? If you buy your options at the ask, if you immediately turn around and sell your options, the difference between the ask and the bid is the spread. That is the money that the market makers profit off of. Why do we want to give them any more money? They make enough money. We don't want to give them any more money. Let's keep that money in our pockets. So first takeaway, keep a tight bid-ask spread of less than 10%. Okay, so if you look at the SPYs, and this is a chart that was an options chain that showed the SPYs a long time ago. I think a couple months ago. I took a snapshot of the option chain. Let's do this math. 373 divided by 382. Okay. So 373 divided by 382. If we minus that, if we minus 1, that, and just disregard the minus sign, okay? That is basically 2%. Is that less than 10%? Yes, it is. Now, let's use Melly. Let's say if we were going to pick the contract, contract, this one right here, which was 1775. If we got into it, it would be $66 or $6,600 because options control 100 shares, and immediately sold it back. It'll be 56. We will sell it to 56.50. That's $1,000 difference. Let's do the math. 56.50 divided by 66. 56.50 divided by 6,600 equals. So we got a minus 1. That is 14%. And that may not seem like a big difference, but I just showed you guys that's $1,000 that we're just giving away to somebody else. Why do we want to do that? Well, we could just pick a better stock to trade options off of. Okay, so you want to make sure that your bid-ask spread is less than 10%. Okay, that's the first takeaway. The second takeaway is if you look at your open interest, This basically, the definition of an open interest is basically how many active option contracts are currently being traded. You want this number to be greater than 100, okay? So if we look at Melly right now, you got like 2, 0, 5. That means that these particular strikes are not really being traded that much. So if you get into the trade and you only have 5 option contracts that are being trading, it's going to be hard to get out of the trade with a profit if you're making money, okay? And that's what we want to do. We're in the business of making money, not giving the market makers our money. No, this is hard-earned money. So if you look at further down, as you get, cheaper options, yes, they have more open interest. And as long as your bid-ask spread is less than 10%, by all means, go ahead and take the trade, okay? If you look at the SPYs, you'll be able to see something like the SPYs. We'll look at the option contracts. You have 275, 354, 428. Trust me, you guys. The higher the open interest, the easier it's going to be for you to get in and out of your trades, okay? That's the second takeaway. The third takeaway is you want to trade options that are highly liquid, that more people are trading. Which options are those? The ones that expired the third Friday of the month. So that'll be the next expiration is March 18th, 2022. But if you look at the option chain, they'll tell you right here. So these are the weeklies, and you can trade them. They're just not going to be as liquid, not as many people trading them as they were as the ones that are trading on the third Friday of the month. Okay, so that's all that means. 3 takeaways: keep your bid-ask spread less than 10%. You want your open interest to be greater than 100 contracts, and you want to choose option expiring on the third Friday of the month. This will ensure that your options are liquid. You can easily get in and out of your options, and we can make more money because that's what we're here for. Bull, bear, we don't care. We know how to make money when the market goes up and the market goes down. Thank you. If you like this video, go ahead and follow me on YouTube or subscribe to my blog on my website, Dr. KJ Trades, and give me a call. Let's talk trades, okay? I'm also offering private coaching if you're interested in that as well. Let's get paid. Thank you.